Good morning, everyone. Well, thanks for joining me here while I go through the daily plan and see what's going on. Okay, and it looks like we're at the top of what I identified as the chop zone, and we're kind of pulling back a little bit, and we'll talk for a minute about how I arrived at these zones and all that, these levels in a minute. First, a quick recap. Yesterday, we had a 1% drop day. Breadth was negative kind of across the board, although the equal weight RSP was down about 0.4%, while the index, the S&P, was down about 1%, and NASDAQ about 1.5%. Here's the RSP, the equal weight. That doesn't look great either. So long story short, the Meta, the Microsoft negative earnings reaction pulled us down yesterday. And now here we are again today with Amazon and Apple pulling us back up. And we've been having these, although volatility on average has been kind of doing what it's supposed to do, quote unquote. I'll show you what I mean. So here was the expected move from last week to this week, last Friday. And remember last Friday, we kind of had we kind of had some weakness. And so the top of the expected move was a little, I would say, artificially depressed, yet still we're within the expected move for this week, with a couple of days of trading waters staying in place. Where are we here? And a couple of days of large moves one way or the other, but on aggregate, we're quote unquote right where we're supposed to be. So that's made it a challenging environment for some people to trade in. Okay, so let's talk about volatility space real quick. You find what I'm looking for. If you guys have been watching, you know that's a standard feature of me trying to find stuff. Okay, so yesterday we had VIX once again pop to almost 17.5 and pull back. We've been having a lot of this kind of choppy action in VIX corresponding to what's going on in the index. The 9-day VIX yesterday was not quite as responsive as it had been in the past, although it still did outperform. Why do I talk about the 9-day VIX and look at it compared to the VIX? As the name implies, the 9-day VIX is the short-term VIX. Now, quick nuance, what the 9-day VIX measures is not the aggregate volatility of the VIX for the average VIX volatility for the contracts for 9 days. It's the Friday before the 9 days, i.e. today, and the Friday after the 9 days, i.e. next Friday. And then it kind of rolls over. Similarly, the VIX is not all 30 days summed up, whatever. It's the Friday before the 30 days and the Friday after the 30 days. Doesn't try to overweight a monthly or whatever, which may or may not be a flaw in the construction. And I think the monthly matters. But be that as it may, it's not up to me. And so that's it. That's what it is. It is what it is. Now, with all this up and down, the VVIX, while it responded, it kind of responded less than its norm. It's supposed to respond about 0.75 to what the VIX does percentage-wise, and it hasn't. It's been kind of underreacting just indicating that it's more near-term stop and slop. And this is the constituent volatility. I'm not going to really talk about that now, the dispersion, but we have stuff rolling under the hood. It may make sense. We have earnings trades coming, earnings volatility rolling on and off, and that rolls into the dispersion trade where institutions sell index volatility, SPX, and use that to buy constituent volatility, Apple, Amazon, whatever, through whatever magic formulas they use. And sometimes that gets a little stressed and things might break. Volatility gurus have been saying it's a little stretched, but then it seems to kind of come back in. I'm not quite worried about it personally. Okay. Oh, there's my boy. Welcome. So, Fed commit, statement, dissent, policy stance only moderately restricted. Okay, yeah. So Schmidt, I guess we get to see this little news flash here, who was the one Fed guy who was a dissenter who didn't vote for a cut, just made his little statement and about why he didn't vote for a cut. And the market, if I could find where I am here, I guess that's the wrong one, which is the right one. And you guys are going to indulge me, okay? And the market said, okay, a little pullback. It's no surprise the algos have to do something, and then we're kind of back to 75. Okay, let's look at the map here. And FYI, Drew, you asked me where I post this, and it's in the Discord, in the server, where in the thread called Random Updates, Charts, and Ideas. Maybe we should rename some of these things. One of these days we'll do that. But that's kind of where I put observations, charts, and whatever.
Thanks, Doc.
Okay. So anyway, so here's what, so here's the market maker exposure chart from Options Depth. And I use lots of different services. I just find this one easiest to visualize and to explain. And so quick review for those of you that have been watching that are familiar, and quick little teaching moment for those of you that are not quite so familiar with this. This is market maker's side of the table. So customers, you and me and hedge funds, buy or sell options. Market makers are on the opposite side of that trade. And so this is where market makers are long gamma, or long options. This is position number. So market makers are long these strikes because people sold them. Market maker long gamma, people kind of talk about market maker positive gamma, this, or negative gamma, this, and that's what this is showing us. And again, kind of oversimplification, when market makers are long gamma, they hedge against the direction of the move, providing liquidity and slowing movement. And when they're short gamma, it acts as an accelerant or an attractant, pulling toward a level. Now, there's also other things, because these tend to decay and could push us up or down depending where they are. I don't know why it's doing this. But we'll get into that maybe some other time, when we get into that in the Discord intraday while we're just talking about it, or in webinars. But so long story short, okay, Doc, so tell me how to make money today. Fine. Okay. So here we are. So right now we're around 75, and we have this cluster of market maker positive gamma. from 60 to 75. So this should act as supportive and sticky. We kind of should kind of bounce off of here or stay in this area. And we have this 68.90 market maker short that's kind of trying to act as a magnet. But as we see, we kind of end up getting sucked back into this cluster. So think 60, 75 is this cluster where we're going to kind of hang out, at least at the open. And notice these numbers are small. 500 contracts, 239, 239. Here's the number of contracts. We have maybe 1,000 over here. So this whole cluster is somewhat small. And what happens as the day opens intraday is there's buying and selling of options near where we are. So these levels can get overrun, but that's kind of where we start. The larger levels are going to tend to stay. 75 is going to tend to stay. 40 is going to tend to stay, although if people start buying 58.50 strike puts or 58.50 40 put spreads, this can get amplified. U.S. decided to attack military sites. Oh, I kind of like that personally, but let me not make a political thing. I have a Venezuelan friend who is worried about the whole situation. Good. I posted something about the Venezuela economy and oil and actually how that might play out. But anyway, we'll get to that in a minute. Well, no, actually, we won't. So what are the zones? Broadly, 40 to 75 is sort of one zone. Maybe we overcut 75 and pull back in here. Within that zone, if we have some weakness, 60 to 40 is one chop zone. Here's a stall zone, sticky zone, 60 to 75. If below 60 really, there's really nothing from a market maker point of view to support us. There's a psychological round number at 50 where we might see some action if we go down here. And so think 60 or 55 is the gateway down toward the bottom of the expected move, which is right around here. Doesn't mean it has to travel the whole way and we could bounce and get stuck in there. Let's just kind of follow the levels down. If below 68.40, I always write my plan in if then. Why? Because it's path dependent and conditional. If this happens, we expect this reaction. If it doesn't happen, well, then we don't expect any reaction. And gamma is sensitive to movements in price. So the amount of hedging response from market makers, which is what we're looking at, a prescription, not discretionary, they pretty much have to do it. As we head down there, they're going to have to balance out their deltas. That's what they do. And so buying would show up here at this 40 as we approach it. But if we break 68.40, again, there's really nothing in the chain right now until down, near yesterday's close, 68.15. I'm not saying that's going to happen. I'm just saying that's what the landscape is. Below 68.15, we have a cluster of market makers short, customer long puts down here. 6,800, the biggest strike on the board. Round number, people own it. It's going to decay, probably unless we go up there, creating a gradual charm drift pushing us upward. Down here below at at 67.75. We have customers selling who sold puts. That's going to act as support. Should we get down there? I don't think we do, but it's there. Up on top, should we get over the 75.90 fly looking structure? I like to think of them as flies, as butterflies. 75.90 fly with this in the 75, 6,900, plus kicks, support resistance, bouncy area with 90.85 in the middle. You can kind of just picture it like that. Picture a triangle. And although this is bigger and this is small, the combination of these three should kind of act as a reaction zone if we can get over. And we often travel through zones. We can hang out in here for a while, then get stuck in the 60, 75 zone, then go back down toward 50, then get stuck back in here, then end of the day, end up wherever. Okay, so that's that. Let me talk about what else is going on, and that's the JP Morgan collar restrike. And to better visualize that, let's just go here to depth view. I want to see position number. Am I encouraging of DEI, avoiding offensive language? Probably not. I try to be a tad sensitive, but if that's going to turn you off, then don't join. Yeah, I'm going to be honest with you.
Not join if you're interested in making money.
Yeah, right. It's think of it as a locker room. And I tend to joke, so I tend to make jokes about whatever. Okay, so the JP Morgan collar.
Doc, I'm stepping back. I'll be right back.
Okay, that was you. Okay. Thank you. I appreciate that. See, you got me. You got me. I know some people are real sensitive about that. Yeah, I'm definitely, and I would say more on the Howard Stern than in the, I don't know, than the Rachel Maddow mold. I think Rachel Maddow is a wonderful human being. So here's the JP Morgan collar, 66.25. So quick explainer about what the JP Morgan collar is. So for those of you that aren't familiar, the locker room people are coming out. Please join. And actually, we have an area in my Discord that's a walled garden that I'm going to open up at some point, have to figure out how. It's a lot of my trader friends that have been trading with me for years that are, if you think I'm a tad whatever, it's gloves off. It's nasty memes, it's nasty comments, it's name calling at each other. It's all that stuff, but they're good traders. And that's kind of like my friend is kind of like letting you guys under the hood, and we're just gonna have to figure out how to do that without having the thought police arrest us. Anyway, so the JP Morgan collar. What the JP Morgan collar is, for those of you that aren't familiar, and we'll go over here to illustrate it. So with the JP Morgan collar, and those of you that are familiar, you might need a little refresher course. JP Morgan collar is a hedge fund at JP Morgan that sells, I think it's a $500,000 or $1 million minimum buy-in. I forget what the number is. And what they do, and you could do it yourself without a $500,000, you could do it on SPY, whatever. What they do is they go 90 DTE, and so we'll start off, well, let's model out what the next collar is going to be-ish. We're going to go 90 DTE, which will take us to January, end of the month, and they go 5% out of the money. They buy a 5%, 20% out of the money, put debit spread. That's the controlling feature. It's a hedge. It's a hedge fund. It's to hedge your risk, for high net worth individuals, whatever. So let's just keep the numbers simple-ish. Where are we? 68.75-ish times 0.95. That's going to give us 5% out of the money. That's 6,531. So we're going to find something close enough to it. I like to do the brown number one. But let's buy a 6,535 put around the 25-20 delta. We usually end up in that delta range. Let's buy the expensive one. And then we're going to sell 0.8 times the same 6,875 equals 5,500. Nice round number. I like it. 5,500. And why do they do those particular numbers? Because they feel like it. No, I'll tell you why they do those particular numbers. They do those particular numbers because their research shows that within a 90-day period, even when we have a bear market and we're down 30%, 40%, by the end of 90 days from now, we're only going to usually be down 20%. Rarely do we do we violate that on a 90-day rolling basis. It happens whatever X percent of the time. You can look on their website and their research. So that's why they do it. And rarely, if ever, does this collar expire in the money or does it make money? It's a hedge. And to pay for it, we're going to build a wall, make Mexico pay for it. They're going to buy a hedge and make the market makers pay for it. They're going to sell to the market makers whatever call they can sell to pay for it. So this is what controls the call they sell, what they have to pay for. It's that simple. So let's just kind of make it a nice, easy round number. So they're going to sell a 72.25 call. That's going to be the hedge. Now this is the mama bear. They have three funds. They start off with the big quarterly one, the September, the December, the March, the June. But business was so good that they introduced this one, the mama bear, which is around 9,000 contracts, 8 to 10. And then the baby bear, which is about 6,000 contracts. So now they have one every month rolling off. The mama bear matters. The papa bear matters the most. And the baby bear still matters locally on the day of expiration. There's going to be 5,000, 6,000 contracts there, and you have to account for it. Now, if they're near us, then they matter. If they're far away, then they don't. Now, the other thing is they don't manage these. Once they put them there, they're done. Not discretionary, systematic. It stays there, end of story. And so we know that's a feature that's going to always be on the landscape. And right now, talking about features on the landscape, the feature that's on the landscape for the JP Morgan collar for the end of December is, drum roll, let's just change this to, let's just make this open interest. Open interest, is that open interest? No, where's open interest? So open interest here. Here it is, 7,000. 7,000, 60,000 contracts. I think 40,000 of them ish are JP Morgan's. The other 20,000 are Chewy's. The other 20,000 are his. About 5,000 are mine. Let me get this off. Okay. I like this one, though. This is interesting. The market doesn't seem to care. Now, what happens more often than not, just like we are now, is this ends up first being an attractant and a sticky zone as we get to it. And we typically have been ending up at or above the collar. So 70,000, 7,000 is going to be sticky. It's going to be a fight when we get there. I think we will. And eventually might end up being support as we go past it. That's what history tells us. Does it have to be? No. But that's what history tells us. So that's the JP Morgan collar. So they're going to do the restrike today. It's not a roll. They don't buy back and then roll it. They restrike it. They let what's there expire worthless or expire in the money, whatever it is. Now, to balance out the deltas of all those negative deltas coming in and what they have expiring, and not to screw the market makers, technical term, what they do is they buy, so that they're going to be selling whatever it is, negative delta. It's about a 50 delta negative. They're buying the 25 delta puts times 10,000, negative, and they're selling the calls. It ends up being about roughly minus 0.5 delta times whatever it is, 8, 9, 10,000. To balance that off, they will buy more or less 1 delta in the money call to balance it out. Half the number of contracts because of 1 delta, half the other one, okay? So they might buy the 6750, and you don't really know which one they're going to buy. I think last month, they actually bought the one they sold. Don't quote me, but I think they did, and that's rare. They're usually just going to get the nearest one, and then they just get all that money back. They don't really lose anything for that. So whichever one, however they manage that, that's what they do. Now, what tends to happen when this hits, and it hits between 2 and 230, 215. Last month, it hit a little early. It hit closer to 2. Typically, it's a little later. You sometimes get some crazy wobbles. You're looking at your screen. You go, oh, WTF? What happened? And that's what happens. But then after the initial wobbles, typically it ends up being supportive through most of the day. People assure me that it shouldn't be, according to the math. Fine. Anecdotally, it tends to be. That's all. Do what you want with that. Anecdotally, it tends to be. Does that mean we can't go down? No. That means it tends to act supportively. Those positive deltas come in, and it just tends to act supportively somehow, some way by magic. Then at the end of the day, since we're talking about this, might as well finish it up. They sometimes restrike. What does that mean? Well, let's just say that when they did it, we were at 68.75, right where I just estimated it, right? And then at the end of the day, we end up closing at 69.25. Oh, guess what? Now that short put's not 5% out of the money. Now it's 3% out of the money. So they buy it back and they roll it. So they do roll after the market closes. Sometime, I would say more often than not, and they might roll the whole thing up or down a little bit. That sometimes makes funky action at, in the after, in the 4 o'clock futures trading. So Chewy, if you like to scalp that stuff, know that there might be some funny wobbles if they restrike. And what sometimes that creates a little instability into Monday, not always, usually not, but it can. Okay. Speaking of Monday, once we go into Monday, this end of the month gamma is gone. Now let's talk about gamma notional. People like to, because it makes good clickbait headlines, talk about all the gamma that's expiring and how that's gonna do whatever. Well, most of the gamma that's expiring is deep in the money or deep out of the money and doesn't really matter. What matters is what's local. Say within 16 delta top or bottom, 10 delta extreme, 25 delta more normally. So what matters for today is what's going on. I'll be extreme. What's going on? Okay, duh. 6,800 or 6,825 to 6,900, 6,925 on top. Those are the deltas that are expiring today that matter. The rest of it is BS, is bullshit. The rest of it doesn't really matter. But still, it makes a better meme if you could say there's X trillions or all the delta for today is going to be wiped out or all the gamma, whatever. But we do go into November thin, and I would expect the first week of November to be a little sloppy before we tighten up going to the November options expiration. Then we get the decay of long puts from below, because in the AM monthly, the tendency is for institutions to buy puts, sell calls, traditional collar type trades, which has a natural tendency drift of the puts decay. Market makers buy back their shorts that they had to sell to hedge the puts. Buyback says up. And then the drift toward the upper short market maker long strike might be a tad counterintuitive. So let's take a look at that. Let's go back to over here to talk about it. And this is something that people sometimes, you might have a little trouble wrapping their heads around. I don't know why it keeps defaulting to the colored one. I don't like the colored one. Come on. Stop. Okay. What ends up happening, and we'll just kind of walk through an example. It doesn't really matter which one. We'll pick 6,900, it's a nice round number. Let's just say we're heading in this direction. As we head up, well, market makers are too long. This is positive delta. Now they have too much positive delta. They have to sell. Okay. But then what happens as we walk away? Oh, now they're too short. They have to buy. So this tends to have that mean reverting drift toward it. And if it's big enough and if we're close enough to one of these levels at the end of the day or at the end of the month, they become sticky and we tend to go right near them. And then sometimes at the end of the day, there's these, algos that come in and kind of screw with it. And, we might go down 5 or 10 points or up through it, depending how clever the algos are. But typically not. Typically, and just amplify that on a monthly basis, what's expiring in the November monthly will tend to kind of have that action and end up near there. If we go above one of these, then they become supportive. And what happens is, let's just look at it from this direction. As we go up, as we go down toward it, market makers have to buy. They're too short, they have to buy. But as we move away, then they're too long, they have to sell. And so one below it gets sticky. So these become sticky in a mean reverting, drifty kind of way. These become, the market makers short, become kind of magnet attractants. But just like if you were ever long an option contract in your life, and okay, it goes in the money or it stays there and it increases value. If we stay there and time passes, it starts to lose value. So these kind of have the opposite thing. These become attractants, but then if this stays there, let's just pretend it's there and we're here and it's not in the money, it starts to decay and become a 0.5 delta, 0.4 delta, and it rapidly decays. And then the market makers get to sell what they bought to hedge this, and that sends us down. And similarly, with long one below us, they get to buy back what they bought to hedge it, and it sends us up. So that's the dynamic question I see. When does market maker sell into move again? Negative delta below. And okay, so market maker sells into the move if the market maker, right here, the market maker is long gamma. So they're too long, so they're going to sell into that move. They're going to sell into that move. Then as we move away, they're too short. And the same thing, the reverse on the way down. They're always trying to balance their deltas. And here's where their long gamma means they're long delta. Customers are short over here. And that's what goes on. I find it easier not to play the delta game that much, because that ends up being too many convolutions of round and round. I just think the long gamma here, we're going down, and market makers are getting too short, and so they have to buy. And are you wondering about negative gamma? Okay, gotcha. So negative gamma is kind of the reverse. So let's just say we're coming from 68.75. Market makers are short here, so they have to buy because they're short. So they have to buy into the move, accelerating the move. But then when the move slows, then they get to sell unless this goes in the money, and then it becomes a delta balancing act. And if that stays in the money and it stays there, let's just say hypothetically, and we get to the end of the day, let's think about this. Let's say we're at 68.95, 92. Let's pretend this isn't here at the end of the day. Let's just say this is 50, 52 delta, 55 delta, 60 delta even. Well, if that stays in the money, that's going to rapidly become a 1 delta. And so it decays up, so to speak. It charms up to a 1 delta, sometimes forcing a big buy, forcing that crazy move up that you sometimes see at the end of the what WTF? What happened? We just jumped up 10 points for no reason. Well, that's the reason. Similarly, on the opposite side of that, let's just say we're at same hypothetical, 68.90, and we're at 68.91, 95, 89, and this is kind of hanging in there. It's a 50-ish delta, and now we're at 88, 85, a little bit below it, and we're coming to 5 or 10 minutes before the close, and we start to stall, and this rapidly starts to lose delta, and then they get to sell whatever they bought to hedge this, and we get down goes Fraser bar, maybe 5 point down at the end of the day, 10 point down all of a sudden, and you say again, WTF. And so that's how that works, especially at the end of the day. It's not quite as sensitive, not as sensitive in the beginning of the day because the deltas don't change as much. You know how time decay works, you know, you buy a 0 DTE call, say, and its price is not going to decay that much in the first 10 or 15 or 20 minutes or even half hour-ish, but I don't know why it keeps on defaulting to this. I'm going to have to talk to their support. It's not supposed to default to that. But these rapidly lose their value, and that's what the decaying things are on the other side. Did that answer your question? If it didn't, I'll try to do a better job answering. Okay, so let's take a look on how we make money. We have what is it, a week trial? Let me shut up and let Chewy talk, and he'll talk about the week trial because he handles the admin. I think we have a free 1 week trial and we have a sale. So I'll let him talk about that. As he talks about ES, he runs the ES scalping room and the training course for E-mini trading and all that kind of thing. So without further ado, I'll shut up because I can keep talking, which I do all day in the Discord. And yes, but the short answer is yes. If you want the short answer about the trial, the answer is yes. If you want the long answer, I'll keep talking. Go ahead, Chewy. I'm sorry.
Yes, just to answer that, there is a 7-day trial. It's on the Whoop doc. If you could provide the link, that'd be great. There's also the price action boot camp, which I can get into a little bit later. First things first, I want to get into what I'm seeing here on ES. I think we've yesterday was obviously a very kind of sideways, nothing burger kind of day. I'm excited for today, expecting that not to be the case. I think we have some room to move upside or downside. I'm a little bit more. I'm straightforward enough to kind of call my direction. I think it's going to be to the upside today. I'll give you both plans just in case it's not. If we hold over 900 ES today, I'd like to see maybe 25, 30 points to the upside before maybe even an extension for another 10, 15. But 900 has to hold. If we start to hold to the downside on 900, I would start to kind of envision 880 in the picture, potentially even yesterday's close, which is 855. That's kind of where I'm at right now. Not a lot of other things that I'm seeing on the table, but if right out the open, I can tell you if we can hold over 905, I'll be targeting 920 within the first 10 minutes of the open.
So 905, by the way, and I just love the way it works out, happens to be a sticky gamma strike. See, here we have my gamma levels mapped out for ES. Go ahead.
Okay, yeah, that's kind of what I'm seeing. And if 905 can hold, I would like to see the high of pre-market. That's kind of how I trade. And if we can get the high of pre-market, I think we can easily see 930. At 930, 930 the level, not the time. But at 930, I would see maybe expect a little downside move. If we can get that during lunch, I would expect us to eat up that retracement to end of day for higher.
Okay. And can you put the link in there for the free trial and the WAP and all that?
Yeah, I'll put them in the YouTube chat.
Okay, yes, I'll go on the YouTube chat. And I'm assuming you're on YouTube, so you'll see the link. And there's a free week, and what we're running right now is a special on the. I'll get something out on Twitter over the weekend and wherever, explaining it in more detail. But basically, what it is, it's a 90-day 90-day subscription, paid monthly, for the full bells and whistles. So the full bells and whistles is my gamma levels, these TV strings for E-mini and SPX. And about these strings, there's nothing magical calculated or whatever it is. It's the levels that I see, the way I just analyzed it right now or before. I turn them into horizontal lines. I round off to the nearest 5, and I have, through the magic of AI, turn my numbers into the syntax that TradingView likes, and that's where these numbers come from. You get that, you get the Discord channel, I screen share pretty much all day and I babble the way I've been babbling. I also trade. It's not an alert service, not a signal service. So I don't tell you the trades. I do put my trades in there and talk about it. People see them and you can do what you want. I'm transparent. If I have losses, I take my losses. I try to tell people, but I tend to trade fast. 40, 50 SPX trades a day is not unusual for me. So, so be aware of that. Now, a lot of those are the same trade, so to speak. So it might be selling whatever I'm selling. Say I like to do iron condors and selling them in 2 lots or 5 lots or 10 lots multiple times and buying them back and then moving around and adjusting, but that's what it ends up being. Anyway, so let's talk about some trade ideas. So for the trade ideas, I always like to go back to this. So what do we say? I like to look at the fly type structures. Okay, so I got 40 as a support-ish level. I got 15 below there. And so let's take a look. And so when we see this as pale like this, there's really not a strong hedging demand. And you see there's a kind of drift bias down here if we get down that low. And there's also a drift for the positive gamma up here at 70.75, which is at 69.05-ish on ES. So you have these extremes here, 6,800, 6,820, where we closed. You have these extremes up here at 30-ish, 25 all-time high. I don't think we get to either of them. Now let's see so as a premium seller, first thing I'm going to look for is, I know I have that 40 support. I know I have that 20 level. I know I have 68 round number that tends to be magnetic. So 69, I like to sell 20 wide at 65 cents. That's pretty healthy. That's even better. I like that. So I'll tend to do, I'll put in a 1 lot. I'll put it in right now, right here. I'll come back to it later. Now my regular account, I'll do 5 or 10 and I'll leg into them. This I guess used for demo. It's a demo account, real money, but it's a small IRA that I have. And I also like demo trades in this during the day. On top, well, I'd like to be at 35, but just for fun, let's do 30, 50, 60 cents. I'll do that. I'll do one of these as well. Then what I call my wish trades, 35, 35, 55. If I could get 40 or 45 cents for it, I'll take it in a heartbeat. Similarly down here, 80, 60. Oh, something's wrong there. Oh, that's the hole I see. 80, 60. That's not even bad right there. But let's do even a more, okay. That looks pretty good to me. Now, I normally don't put trades in as ICs. I put in each side separately. So anyway, so those are some things I would look for. I see some weakness as I'm looking here. Lately, what's been happening is we've been getting that VIX top early in the day. We've been kind of selling off and then finding our level. As far as flies, let's look at some flies. So let's talk about how I like to look at the flies. And this keeps doing this. It's getting annoying. Okay. 60, 40, 50 mid. That looks like a decent fly. Something trying to take advantage of this. So let's see. That's way too far away, obviously. Let's move the strikes up. So let's see what something like that looks like. That's not bad for 60 cents, 65 cents. That's not bad. Now we expect the 40 to hold, right? We talked about that. That might not be bad. Anything like this, I think, is good. How much is a 15 wide for $1.20? Normally I like to do 10 wides. I like something like that as a cheapie. And then I'll kind of play with it. Now these are very forgiving. I'm getting a call from a lawyer. I'll have to call her back. I'm buying the house next door. Call fly. Let's move the strikes up. So we have that 75 area and that 90 stick. Well, no, it was the 90 magnet. So we want to kind of get the pull to the magnet. Yeah, it's a bit expensive, right? It's a bit expensive to just kind of do blind. 85. I'm just going to put it in anyway, just for fun. Normally I don't. In a situation like this, what I might sometimes do is put in, yeah, I'm leave it like that. Is put in a 5 wide. I mean, a cheapy 5 wide might be with the 69 mid, with the 6900 mid. I don't think you're going to get much on that. 6900 is where we accelerate to 6890, then I would expect it to kind of stop there. And so we talk about this in the room and play around with it. Scalp levels to watch. We have plenty of scalpers in there. Scalp levels to watch, and then I'm going to shut up. I'm going to have to go. Scalp levels to watch. And again, it's written out in my if-then plan. I haven't gotten my plan out yet on Substack and on WAP. I'll get it out in a minute. Here's a trigger for more downside. Should we break here? Right now we're in the chop zone, so I don't really see much of an edge for a scalp. You might want to scalp from here up or from 70, 75 weakness down. But you want to see how this resolves. And, if we break 65.60, you can get a nice move down toward the bottom of the chop. If we break above 75.80 and hold it, you can get an accelerated move toward the 68.90. That's kind of what we're seeing. We see some pre-market weakness, so we got to watch what's going on. You call or talk about single leg plays? Yeah. I tend to talk in terms of spreads, but actually we have people that do single leg plays. There's nothing wrong with that. The same one, instead of doing a spread, we do a single leg play. And yeah, so I mean, you can do the single leg play as well. So whether you buy, just hypothetically, whether you see 68, 65 break and you buy a 60 or a 55 put, or you buy a 60, 45 debit spread or whatever you buy, it's 6 of one, half dozen of the other. I'm gonna sign off in a second. I'm going to stop screen share for a minute and dig up some links. And then I got to run. My lawyer's calling. I got to set up an appointment to close on the house next door. Links I need handy. Where is it? And I got to get that posted. Okay, here we go. I think this is it. No, that's not it. Well, that is it, including a copy from Discord of, okay, oh, looks like it came out okay. All right. And that's it. I think that's right. That's one. That's two. I think. I'm not great with the marketing stuff. Okay, I got to run. Any final words of wisdom?
No, I always wait first 15 minutes. If you have questions about anything, always feel free to DM me as well. I'll see you guys in there.
Okay, I'm kidding. We're about to start. I didn't send out my daily plan yet. Okay, bye.
Good luck, everybody.